management is shareholder value maximization. We want to maximize the value of the shareholders. As much as the profit is important on the accounting perspective, you'll find that the aspect of shareholder value maximization is very critical to financial management, because there is a difference between the two. So today we're just going to look at some of the concepts, like the fundamental concept in corporate finance, which will also formulate the foundations of what we are going to discuss as we proceed with a module. Okay, so let's begin. Fundamentals concept in corporate finance. Present value. I'm sure you've not discussed this, right? Present value. Okay, so when we meet next week, we will definitely talk about time value of money. We're going to explore things related to present value, future value. So today is just a teaser, right? So what is present value? Present value determines today's value of expected future cash flows, right? So when we are talking about present value, we're saying determines today's value of expected future cash flows. For example, we have got K, who wants to start a project, maybe a chicken project. Today, which is year zero, she expects to use maybe 5 million rand to start the project, to get the land and build maybe the necessary housing for the chicken and the like, and everything that is required. Maybe she is expecting to spend 5 million and maybe buying the chicks and the like, right? But she expects that as this project is going to run in the like, in year 1, in year 2, in year 3, and in year 4, sorry. Okay. So she expects that she's going to use minus 5 million. In year 1, she's expecting that she's going to generate 1.5 million. Right? In year 2, generate 2.7 million. In year 3, she expects to generate 5.3 million. In year 4, she's expecting to generate 4.1 million. Right? So these are cash flows that are expected to be generated, right? So when we are now doing investment appraisal in financial management or capital budgeting, or we're trying to evaluate whether this project Kelly wants to get into is worthwhile, is it viable, does it maximize shareholders' value, we do not consider these cash flows or these sales. We do not consider these cash flows or sales as they are, right? Because they are future cash flows, right? Because I cannot think of 5 million that I'm going to get in 2030 to be the same as 5 million I have in the pocket today. Because the value of money can get eroded over time by things like inflation. So when we're doing investment appraisal and you want to assess the viability of the project, we will need to bring back the future sales or cash flows to year 0, right? So we'll bring 1.5 million to year 0, 2.7 to year 0, 5.3 to year 0, 4.1 to year 0, and get the value of these cash flows in year 0. So that's present value. So present value, we are taking back the future cash flows to year 0 so that we can have a fair analysis of the project, and therefore we can determine whether the project is viable or not. Does it add shareholder value or not? Because if we use these future cash flows, they are not appropriate. Why? Because it is money that we're going to receive later, and its value going to change. Because if you're going to receive 10 million in 2030, it might not be the same as 10 million today. It might buy less than what it can buy today. So when we're talking about present value, we're talking about determining today's value of expected future cash flows. Right. The process of how we do that, for now, do not worry, guys. For now, just hold. We are going to explore it in detail. But as an example, right, just a bit, because someone will be like, let's have it. Like this 1.5, I know you might have it already. You can use a discount rate. So the discount rate is the one that we can use to discount future cash flows back to the present value. So we have what we call a discount rate that we use to move back future cash flows. So you can calculate that discount rate, and when we are going to talk about work, that's when we get the discount rate. We're going to explore that. So you can say 1 plus, if your discount rate is 0.1, then you are going to say 1.5 million. This is year 1, right? 1.5 million divided by 1 plus 0.1. Then you get the value of 1.5 million in a year's time. Today it is 1.3,633,633.364 if we want round to decimal 36. So we are bringing back future cash flows to today, and we do that by using a discount rate, and the discount rate will be provided or calculated as we are going to see later. So it allows comparison of investment with the different cash flow timings, and relies on active capital markets to set appropriate discount rates. So we are going to talk about setting appropriate discount rates. So the aspect of present value relies on active capital markets to set appropriate discount rates. If you have questions as we are proceeding, feel free to ask. Let's talk about time value of money. So it's your choice. You can go ahead after this class. On our Facebook page, there is a class for time value of money. I'm sure that was 2022, 2023 or 2024, 2023, I'm sure, on time value of money. That will be our next chapter. Time value of money. The value of investment depends on both the amount and the timing of cash flows. Right? Investors prefer earlier cash flows as they can be reinvested. Discount rates incorporate time value adjustment. Let's talk a bit about time value of money, which is our next chapter. Time value of money TVM, I'm sure we once took it in the previous class. So when we're talking about the time value of money, we are seeing that the value of money changes over time, right? And that's when we say a rand today is more valuable than a rand tomorrow. I'm sure I gave that an example. When we were saying that if you give me maybe 100,000 rand today, do you know I'm going to invest it and tomorrow it will be 1,000 rand like this. 1,000, 100,000. Sorry. Okay, like this, exactly. I can get an extra 100, right? By just a day. It's possible that I can invest this 100,000 rand, and tomorrow It can be 1,000, it can be 111,000, right? 111,000, it's possible. Or 110,000, it's possible. It's possible. I can make it a 5,000 extra by investing in different instruments, right? So, the money that I receive today, a rand that I receive today, is better than the rand that I receive tomorrow. Because a rand that I receive today, I can invest it, and tomorrow I might have 1 rand 30 cents. Right? Similarly, it's better for you to be given your money now than to be given in 2 months to come. Because if you are given now, you can take it and do some investments, and in 2 months, you can have double that amount. Right? I'm sure together. So when I talk about the time value of money, we're trying to think in terms of the timings of cash flow. So I say the value of an investment depends on both the amount and the timing of cash flows. What it suggests is that it depends on the amount. Like if I have 100,000 rand, I can have 100,000 rand. That's the amount. And the timing of cash flow, I can invest it over maybe 10 years. Right? Okay. And I can have 100,000 rand. And I invest it over 5 years. Right? So, you see that provided the interest is the same, maybe the interest is 15%, same 15%, you are going to have more money. You are going to have less. Right? So, let's assume we've got 2 guys here, 1 and 2. Right? These guys are supposed to be given maybe a remuneration or a pension or what of 100,000. Then the first guy received their money on time, the 100,000 rand on time, and they took everything and invest it over 10 years, right, at 15%. And if what the second guy, maybe there were some challenges and some paperwork which delayed, you had to receive their money, and they received 5 years later. Then they take the same money and invest it over 5 years. Right? It means the second person is going to invest for a shorter time. Compared to this one, we invested the same amount at 15% for 10 years. Here, you invested the same amount, around 100,000 at 15% for 5 years. So you are going to have less. So it's better for me to receive my money early, so that I start counting today in terms of investment and the interest. So the value of investment depends on both the amount and the timing of the cash flow. Which also means to say 100,000 rand, right, being invested for 10 years at 15% interest versus 10,000 rand invested for 10 years over 10 years at 15% interest. This one is going to generate more interest than this one. Why? Because the notional amount or the beginning amount is much higher. Right? So the time value of money, the value of investment depends on the amount and the timings of cash flow. Investors prefer earlier cash flows as they can be invested. So as investors, you prefer to get your money early and invest it so that it can generate interest. Discount rates incorporate time value adjustment. We'll talk about that later. Are we together, guys?
Yes.
Yes.
Well, that's good. Let's talk about risk and return. Risk and return. Investors prefer low risk investments and demand higher returns from risky projects. So as we mentioned in one of the classes, we said we need to understand the rule: high risky, high return, low risky, low return. The example that you gave is, say you have 100,000 rand and it's in your bank account or under your mattress. There's low risk of losing your money, like if you put it in Bitcoin or another investment, right? I'm not encouraging Bitcoin trading, right? 100,000 in a bank or at home under the mattress. It does not give you any return, but there's low risk. But if you take that 100,000 and invest it maybe somewhere, buying shares, there's a possibility to say after 3 months or after a year, it can be 100,000 plus maybe 10,000. So you obtain 10,000 more, right? But there's also a risk that you might lose and end up having 90,000, right? So higher risky, higher return. Lower risky, low return. That's the reason why you see we're going to talk about two types of investment. You can investment in risky free assets. They are what we call risky free assets, and I encourage you, try to pay attention. Also, when you get time, try to visit the classes. Also, our YouTube channel, just go and subscribe, because like now there are some things that I'm not going to talk like today. But if you're on our YouTube channel, you can just go and watch like the video that I uploaded today. It's going to be part of our chapter 3, but you can know some of the things ahead, right? Risky free. So these, as I'm explaining some of the concepts, they may not mean much now, but they will apply later. So I just have understanding. Maybe you cannot get everything, but that little understanding, you will see that it will help you, and it will be like some sort of light when you get into detail with other chapters. So risky free assets, we can invest in risky free or risky assets, right? Risky free, we are thinking in terms of government issued securities, right? So they are instruments. Okay, I have to explain that again. We might have someone who, but I'm sure everyone in financial management is a background of financial management. But let me just explain. Let me write here. So, we need to understand that we are going to use the word security, investment, instrument, or maybe we can just write it into financial instrument. Asset, which is a short form of financial asset, right? Yeah, basically. So when you hear us talking about a security, an investment, a financial instrument, or instrument or asset, financial asset, it's one and the same thing, right? So do not get confused, right? So when we are saying asset, we are not actually referring to the fixed assets, the current assets. We are talking about a financial asset, like a security, an investment, a financial instrument, like a stock, like a share. To say you have invested your money in ShopRite, you receive a share certificate that you have ownership, you share ownership, you have got an ownership in ShopRite. So that's an asset that you have. So it's not that type of asset, that current asset, what fixed asset. We are talking about a financial asset. It can be called a financial asset, instrument, security, or investment. So here we are saying there are risk-free instruments, risk-free assets, which are issued by the government. The government might be looking for money, and they'll issue securities. Then they get money from the public, then they'll pay back later, right? And we believe that the government will not default. So will not default will mean the government, there is no way they'll fail to pay you your money back. As such, we say they are risk-free. There is no risk of the government fail to pay back. So the instruments or the securities issued by the government, we believe that they are risk-free, and we call them risk-free. So you can find the likes of treasury bills as risk-free instruments. So when you encounter treasury bills, you know they are risk-free. Then there can be an investment in risk assets, like you buy stocks or shares of a company, Like maybe you buy for Capitec, you buy for ShopRite, you buy for Pick and Pay, you buy for Woolworths, you can buy for Trude, yeah, if it has got, it's publicly listed, or it's has got shares trading, right? These have got risk, right? But they've got also possibility of higher return. They are risky investments, but they've got possibility of higher returns. We have a situation, those who do 0-2, they're going to talk about state of case. Right? A company whose share price just went down in just a short period. So you realize that there is a possibility of higher returns, there's a possibility of even negative returns. Right? So we need to understand that we can invest in either risky instrument, risky assets, or risk-free assets. We as investors prefer low risk investments and demand high returns for higher projects. Right. So we are saying, guys, if there is a possibility to invest in risk-free assets and get a lower return, right? If there is a possibility to invest in risk-free assets and I get my lower return, maybe 5%, when now there is an offer to invest in risky assets, there should be more return. Do we see? There is a possibility to invest in risk-free assets and I'm getting 5% on those risk-free assets issued by the government. If now there is a possibility to invest in risky assets, for me to choose to invest in those assets, there should be better returns, maybe 10%, which is 5% above risk-free. Because I'm getting to risky, I need favorable compensation. I'm sure together. Companies should only invest in projects offering returns in line with their risk levels. Right? Companies should only invest in projects in line with their risky levels. Right? So, in 01, we are going to talk about, in 02, we are going to talk about risky appetite statement. And we said a risky appetite statement defines the amount of risk the firm is willing to accept in pursuit of its objectives. So the risk appetite statement is a document, or it's a statement that is developed, a policy that is developed by the board and the top management, which define the amount of risk the firm is willing to accept in pursuit of its objectives. So there are some risks which the organization might not be willing to accept, even if there are good returns. So in 03, yesterday, RSK 03, I know you are not doing that module, we were discussing to say the failure of an organization, the fact that an organization has failed does not necessarily mean that risk management failed, right? Because risk management is not responsible for everything. Risk management team is responsible for identifying risk, identify, evaluate, communicate to the top and body risk, monitor and manage. But they are not responsible as to which projects should we get into. Should we diversify? Should we major? They are not responsible for the strategic moves and the main objectives the firm is going to take. We're going to see that when we talk about corporate objectives. So firms should invest in projects within their risk appetite. Risk appetite being the quantity or the amount of risk the firm is willing to accept in pursuit of their objectives. Then we have what we call the capital asset pricing model, who will help us to determine risk-adjusted required return. We are going to explore this later. The capital asset pricing model is a model that we can use to calculate the expected return. It offers us the fair value of the expected return. What it comprises of, the formula is required return, which you can say, if I can say expected return like this, E in bracket R is equal to RF plus beta multiplied by RM minus RF, right? Here we've just shortened it here. So focus on what I wrote here with the pen. So we're saying expected return on an investment is equal to risk-free plus beta multiplied by RM minus RF. Though we've not yet touched on that, let me just break it down. So we're saying that if you choose to invest in a risky asset, maybe, right, your expected return will be equal to, first, I definitely need a return that is above risk-free. So my return should be risk-free plus what is offered in the market, the return that is above risk-free, right? So we are going to see later, as we are going to discuss, that we also need to take note of risk. So that B on this formula represents risk, and it's called systematic risk. Systematic risk. So it is the risk involved in investing in risky assets. So our formula goes by this. Expected return here will be risk-free return, maybe it's 5%, plus the risk in the market, maybe it can be 1.2, multiplied by the market return or the return offered by risk assets, which should be above the risk-free, because I'm investing in risk assets. That becomes maybe 10 minus risk-free. So this bracket is talking about a risk premium. If you see, we are saying 10 minus 5 risk premium, which is saying as you are investing in risky assets, you need an extra return over and above the risk-free return. That's the reason we say that risk-free was 5 from example. We needed plus 5, which is the premium, for us to be willing to invest in risky assets with a risky value of 1.2 symbolized by beta here. Right? Are we together, guys? You're quiet. Okay. Do not worry. You see that as you proceed, you understand these things much more. I'm just giving you more than what I'm supposed to give you as of now. So let me not get into detail because we're going to have the time to get into detail with these aspects. Okay, let's talk about no arbitrage principle. No arbitrage principle, it states that, so these are just some key terminologies in financial management. Risk-free profit opportunities, risk-free opportunities due to price differences in the market, right? So when you're talking about arbitrage, guys, let me not talk about much. Let me just give you the general, the basics about arbitrage. When I say talking about arbitrage, we're talking about risk-free profit. An example that is general is to say, you go to Pick and Pay and you find that Mama's cooking oil is 52 Rand per 2 liters, right? You go to ShopRite and you find that Mama's cooking oil is 89 Rand 2 liters, right? What it means when you are talking about risk-free is to say, okay, let's assume it's possible, right? It's an example. You can do this for you to get a risk-free profit. You can come to ShopRite and say, guys, I want to sell you cooking oil. Let's now assume that maybe we can just, okay, I will sell you cooking oil for 80 Rand. I do not want to use 89, though it's right to use 89. But let's just say you just want to offer them a little lower. I want to sell you cooking oil for 80 Rand. Alright? Because ShopRite, we assume that the ShopRite guys are not even aware that the price is 52 at Pick and Pay. Then you will say, I want to sell you maybe 1,000 bottles, 1,000 2 liter bottles of cooking oil at 80 rand. You agree? Yeah. So in other terms, we'll talk later about forward contracts. So you have locked in the price, and you are saying that I'm going to deliver 1,000 bottles, 1,000 2-liter bottles of cooking oil in a month, or maybe in 7 days or 2 days, right? Then you go, yeah, and buy. But when we are talking about risk-free, we assume someone who does not have a rand in their pocket, right? So what they do, they realize that the cost of them to go and buy 1,000 bottles from Pick and Pay and deliver to ShopRite will be 52.2 rand multiplied by 1,000 bottles. What do we get, guys? $52,200, right? That's the money that is needed, right? But you don't have any money in my pocket. What is the money that is going to be generated? It's 80 rand multiplied by 1,000. The deal can strike 80,000, right? If I have the money, what will be my profit? I'm going to profit 27,800. Guys, this is good money. So what I do is to say, oh, I see that I can go and borrow 52,200 rand from the bank. In the bank, surprisingly, the bank is charging 5% maybe interest or 10%. Let's assume it's 10%. It means I'm going to borrow that 52,200 rand at 10%. The total cost will be calculated as 52,200 multiplied by 1 plus, there will be multiplication 1 plus 0.1, which is 10%. Right? Let's assume it's just over 1 month. Right? 52,200 multiplied by 1 plus 0.1. The total cost of the loan borrowing plus the interest, it will be 57,420. So I can go and borrow 52,200 from the bank over a month at an interest of 10%, and the bank will require 57,420. So I see this deal. I agree with ShopRite. I go and immediately borrow from FNB, Absa, Capitec, or Standard Bank, whichever the bank, right? Nedbank. 52,200. Then I go and buy cooking oil from Pick and Pay. I go and deliver to ShopRite. The ShopRite guys pay me 80,000. From that 80,000, I will take 57,420 and pay back Absa or FNB. Right? The money that I borrowed them and their interest. And after the process, I'll be left with 22,580. That's my riskless profits. I just managed to see price differentials. So when I talk about arbitrage, these are opportunities that can exist in the market due to price differences, or the fact that prices are quoted differently. We'll talk about this more in Fin 4802, when we can say banks can quote different exchange rates, different current pairs differently, so that someone can buy from one bank and sell to the other for a profit. Though now it's difficult because of technology, because the systems are updating the things like automatically. But I'm able to see and understand the aspect of arbitrage, guys. Is it clear?
Yes.
Well, so we say prices are
Yes.
Well, that's good. So the second statement says prices adjust quickly to any net arbitrage process. So you find that you might not be the only person who realize that deal. Maybe the first, when you buy, you deliver the bottles to ShopRite, another person is also coming to ShopRite to the same deal, another one. So these guys will become worried to see what's happening until they discover that there is a loophole in the market at Pick and Pay. When they realize that, that's when these guys who realize that no, let's maybe lower our price, then this one maybe say, let's increase our price until the price are the same. So that opportunity in the market will not exist forever, because it has happened because there was no enough information. But when the information is now available, those opportunities will disappear, because there will be more demand from Pick and Pay and increase the supply to ShopRite until the information is unveiled. Important in capital structure, pricing, financial instruments, and derivatives. So I say the aspect of arbitrage is very important, and in most cases for Fin 482 will be asked a question like this in the examination. Efficient market hypothesis, we need not to talk much about it. We'll talk about it in detail, I'm sure, in ECS 4863, and we might apply it also a bit in HRFin. Securities prices reflect all available information instantly without bias. When we talk about the efficient market hypothesis, it suggests that security prices reflect all available information instantly and without bias. So we are saying that the price even of assets, or the price of stock, or the price of ShopRite stock, is a reflection of what is in the market and the fair value of ShopRite stock. Investors cannot consistently earn excess returns beyond the risk-adjusted return. So according to the efficient market hypothesis, we also believe that there is no possible way that someone can get an extra return or more value to maybe their stocks than their actual value, because the value of a stock in the market is a true reflection of its actual value. So market efficient ensures fair pricing, but behavioral finance suggests occasional inefficiencies. We're going to talk about that later. Portfolio theory. Portfolio theory is talking about diversification and reduces risk. We will explore about that more. But what it suggests is that we are saying that we had our 100,000 rand, guys. Do you remember? We said we could invest it in risk-free, and we said the return was 5%, right? Or we can take the 100,000, and you said we can invest it in risky assets, and the return we said can be 10%. Because they are risky, it can also be minus 10%. If it is 10%, we're going to have, that's 110,000, right, guys? Yes. But if things go badly, we're going to end up having 90,000. All right? We lost 10,000, right? But we want to avoid such a situation. Can we try to balance? When you want to try to balance, that's when we start to talk about the portfolio theory. To say, do not put all your eggs in one basket. Right. So what we do now, instead of depositing all our money or investing all our money in the government or in risk assets, we now do a portfolio. A portfolio, by definition, is a group of assets. Remember, we said assets or security or investment is a group of assets or investments held together. To eliminate risk, when we are talking about diversification, we are saying it's better for us to spread our money or our investment across different sectors of the economy. In case one fails or performs badly, the other one might be performing well. During COVID-19, if all your investment was in tourism, you're going to be affected deep, very bad. But if you had some investments in mining and health, they were considered critical critical sectors, and you could gain a better return. So in this case, instead of pooling all your funds in one investment, you can pool your funds across different sectors or investment areas. So we can say 50%, let's put it into treasury bills or government securities, which pay 5%, and 50% of our money, let's spend it on risky instruments, which pays 10%. At the end of the day, we are saying 50,000 is invested in the government, and 50,000 is invested in risky assets. Here we get a return. Here, if things go bad, at least we're gonna get maybe some return here. Maybe it's 2.5, right? 5% of 50,000. Here, maybe we can get a minus, which can be 10% of 5,000, right? But at least it's better than losing everything, than losing 10,000. Because if we are going to say we lost from the 50,000, we lost 5,000, it's gonna be offset a bit by also the return that we're gonna get on those risk-free. Because we're going to get 2.5. So at least we're not going to have 5,000 loss. But if things go well, we can get 5,000 here and also 2.5 here. So we are diversifying risk. So a mix, let me change the color of my pen. So we are only saying a mix of assets across different sectors can lower risk without reducing returns. Modern portfolio theory quantifies diversification benefits. Are we together? Are we together, guys?
Yes.
Yes.
Well, the capital asset price model, we'll use it in detail later. We use it so much. It measures the risk of financial assets and determines the required rate of return. Remember, we said the formula, we can write it as expected return is equal to risk-free plus beta multiplied by RM, market return, minus risk-free. Sometimes you can find it like this, is equal to RF plus beta multiplied by MRP to say market risk premium, which means they have already calculated here RM minus RF, so it will be just one in the same thing. We'll say it distinguishes between diversifiable, eliminable, and undiversifiable systematic risk. Right. So, in a risk, we've got two types of risk. There is what we call systematic risk. So if you go even on our YouTube or Facebook, you can find some of these things in detail. Like there's a video on systematic and unsystematic risk. And we also request that you can just also subscribe, because most of the people, they just watch and they do not subscribe. Okay, systematic risk, guys. Systematic risk is the one that is clear on our formula. This B represents systematic risk. It's beta. Systematic risk, guys, is what we call undiversifiable risk. Undiversifiable risk. You cannot reduce systematic risk through diversification. Cannot be reduced. Okay, right. So we have systematic risk and unsystematic risk can be reduced through diversification. So those are the difference. Just asking you guys, from what you think, the different types of risk that you think can be available to a firm. Just tell me, guys, what an example of a systematic risk can come to your mind? A type of risk that even if you choose to diversify, to say we are going to have investments in the mining sector, in the youth sector, in the tourism sector, in the FMCG, fast consumer moving goods, or any other sector, we cannot reduce risk by doing that. What are the examples of such risks which can come to your mind, guys? Do you think any example of that kind of a risk? Okay, maybe we have not yet explored some of the things. So, a simple example, guys, that you can think, you can look at even the macroeconomic risks, like inflation, right? Inflation, let's talk about inflation. You know, you cannot escape inflation, even if you are in the mining sector, or in the FMCG sector, or the health sector. There is nothing that you can do as long as you're in South Africa. The inflation is the same. Because you want to buy stationery. There is no way a shop can say the companies that come from mining sector, we're going to sell them at this price. No, you equally suffer the consequence of inflation. So you cannot diversify such type of risk. Another type of risk, exchange rate. Right? You cannot be no firm is immune to such kind of risk, and it will affect firms in mostly proportional terms. You cannot say because I'm in this sector, I'm gonna get a different exchange rate from other firms when I want to buy raw materials outside the country. So you find that it is the same. Just go and think of other risks. Some of the risks that we can think are operational risks, like COVID-19. As much as I talked about it to say it's how you can eliminate by diversification, but you can find that in most cases, natural disasters, pandemics, and most of the operational risks, as you're going to study operational risk, they become, most of them, some sort of systematic risk. When I talk about them at a large scale, like natural disasters, like a flood. When a flood hits a certain area, no company can be immune or can survive because they've diversified. If there are mining companies there, if there are youth companies there, they're gonna be equally affected. Right? Let's proceed and make sure that we cover some stuff, right? Financial analysis. Understanding financial statement is crucial for corporate finance. I'm going to talk about that later. It also helps company investments, working capital, and financial structures. We'll look at that later. Financial managers use accounting data to estimate future cash flows. Something to talk later. Managerial actions and shareholder interest. Agent's problem. Managers may act in self-interest rather than maximizing shareholder value. We say the primary objective in financial management is to maximize shareholder value, but shareholders are the owners. They're responsible people who are managing the company, that are managers. Managers might end up driving the company towards their interest at the expense of the interest of the shareholders. Maybe buying them the latest cars, going to Dubai for holidays and for meetings, right? Potential managerial excesses, high executive pay, high executive pay, corporate perks, inefficient expansion, aligning interests, performance-based incentives, shareholder activism and governance structures. Let's explore. Investment decision making and risk appetite. Companies must weigh projects, risk and returns. Right? There we're talking about also risk appetite, because we said risk appetite is the amount or quantity of risk a firm is willing to accept in pursuit of its objectives. Right? So when you are making an investment decision, it's not only the return that you have to focus on, also the risk. Does the risk fit within your limits? You have a risk appetite statement set by the board of top management, which defines the amount of risk or the quantity of risk as a company are willing to take in pursuit of your objective. So if the risk is beyond or is above the appetite, then you are not going to take. But if it is within the appetite and the returns are favorable, then you can go for it. Shareholders prefer risky but profitable ventures, while managers avoid risk. So as shareholders, owners of the company, you might want risky investment because they give profits. But the managers would want to avoid that, because if the company fail, they are the ones who are to be blamed. They are likely to be the ones who are said to be failed. So they are conscious when it comes to risk taking. They do not want to take much or excessive risk, because it will put their reputation in their jobs online. Rational investment requires balancing expected gains with expected risk level. So it's not just the vivacity, the effervescence to say we want to have more returns, but there is a recognition to say with more returns comes more risk. As such, there's need to strike a balance between risky and return. There should be an acceptance that as more returns are wanted or expected, more risk should be also accepted. Right? But rationally, we need to balance the two and accept that we cannot just have more return without assuming or accepting more risk. I'm sure together. So we've covered the part of the part that we're talking about the fundamental concept in corporate finance or financial management. Now let's just talk about these things. These things are just important for you just to know. But those who do 02, I'm not sure if you've got guys who do RISK for 02, you are going to definitely come across, and the reason why you are not going to explore everything, there will be a repetition. But for the sake of others, we need just to have a background knowledge of these things. Okay, do managers act in the interest of the shareholders? Really? But that's what they should do. Let's talk about the agents problem. Separation of ownership and management. Managers or agents. So, those who did law, there is what we call the principal agent relationship. Alright. Managers are agents who act on behalf of shareholders who are principal. So, agents should act in the best interest of the principals. Like if you're an agent, you are not going to do what you want. If you are sent somewhere, you are not going to say what is in your heart or what is in your mind. You say you're going to represent the signatory or the authority which have sent you. So you are not going to act in the interest of that authority, who is the principal, not yourself. So managers act on behalf of the shareholders or principals. But now the conflict happens. The potential conflict is when managers prioritize personal interest over shareholders' wealth. It's possible. Actions that may not favor shareholders, unnecessary luxuries. When you find the managers of the company, of the bank or companies buying corporate jets for themselves, expensive travel, high-end offices, the furniture, the chairs, 100,000 laptops, is that justifiable? Spacious offices that are just expensive. Right? I'm sure I was discussing with the yesterday guys. For you to also understand some other things that happened during the 2000 global financial crisis, you do 02 also. It's also something that is just necessary. I'm sure some of you watched that documentary. If you go to our YouTube channel, there's a documentary which is interesting. Maybe now you might not get everything. Maybe you can delay watching it, or you can go and watch it again. It talks about the 2008 global financial crisis, and it explains what happened. If you realize what happened, guys, some of the bank officials managed to take profits as much as 300 million in a year from the bank, but the bank is suffering. But at the end of the day, the bank collapsed, and we are using the public's money. We're using poor taxpayers' money to rescue those bankers, because the government is saying we are bailing out. That's too big to fail. The corporation is too big to fail. It can lead to a catastrophe, right? So let's rescue it. The government will use the taxpayers' money to rescue it, but someone engaged in excessive risk and went home with 300 million, but leading to the collapse of the company. So excessive executive compensation should be taken note of. It's not right. Excessive compensation, right? You can go and watch it. It can help you. Unrelated acquisitions leading to inefficient diversification, right? So we also say that, if you still remember, these modules are interrelated. So I'll be trying to manage my mind so that I'll not end up talking much of 05, though they are related in FinFo 2. We also say that it is the role of a risk manager to see that the projects a firm is getting into are related to the corporate strategy, to the strategy of the firm. Similarly, it is also part of the role of the financial manager to evaluate the project the firm is getting into. Does these projects correlate or relate with the firm's strategy? Because as much as diversification is good, there is diversification or acquisitions which can lead to the failure of the company. So managers can do that, maybe for some interest, which can lead to the collapse of the firm, and such has to be taken note of. Avoiding high-risk projects to protect personal job security, because shareholders want maximization of value, so they also expect to take challenging projects or business ventures. But you can find managers who are acting as agents of the principals, the shareholders, avoiding high-risk projects because they want to avoid failure and they do not want to take much responsibility. So to protect their jobs, their reputation, and their security, they avoid high-risk projects. Also, underutilization of debt to reduce personal pressure from the lenders or bank managers. So you can find, as we proceed, that use of debt is good sometimes in the company, right? Because it goes with some benefits like tax benefits. So companies can use debt sometimes to reduce the cost of capital and some other advantages it has. But managers can avoid much use of debt so that they will not receive pressure from the bank managers and the lenders in terms of fixed interest payments and to run the business properly. You see? So these are also actions which can be done by managers, not in favor of the shareholders. Are we together?
Yes.
Well.
Yes.
Well, that's good. Let's talk about aligning management and shareholder interests. We need board oversight. Shareholders select board members to oversee management. So we will see that companies will have board of directors which oversee management, corporate governance, regulation like Companies Act and King 5 promote accountability. Those who do RSK 502, if you want to know, you are going to talk much about this. So through board oversight and corporate governance, companies can be better managed, and the direction, the moves of the management can be also managed through that. Performance-based incentives, share options encourage management to increase share value, However, misalignment can lead to excessive risk-taking, financial crisis contribution. So you see, financial crisis contribution, we're talking also of 2008 global financial crisis. So that documentary can also help you. I'm not going to talk much about share options because it can, for now, it's not okay. But if you can remind me later, I can just explain about that to you. So, because it's going to talk about derivatives, and we need to an understanding of derivatives. And you see, when you're talking these modules, there's also an assumption that you have got a background knowledge of these things. But we try to explore and say as if someone does not have a background in finance. So that's what we do, right? To assume like someone does not have a background in these modules. So we realize that we try to explain everything. But when you're trying to talk about a share option, for now you might not really understand it. Maybe we need to talk about what is an option first, then we come back. Alignment also, we're talking about threat of takeovers, poorly performing firms, risk acquisition, and leadership replacement, right? So if you're performing poorly as a firm, there's a risk of other firms try to take you or acquiring you. You're engulfed by other company, you're bought or you're acquired by another company, or management or leadership or replaced. Potential issues with incentives, large CEO payouts despite poor company performance. I'm sure there are a lot of companies, especially for those who do 02, and we're gonna look at some. You can find companies which paid huge salary, huge payouts to the CEOs, while the company is performing badly, right? So that's when you want to check the authenticity, the veracity, the necessity of such a big payout when the company is not doing well, struggling. Share price movements influenced by external factors, not management skill. But share price is also one of the most important things. Remember, in our previous class, we said that we are not much focused on accounting profit, but we are also concerned about maximizing shareholder value. But we come and see that aspect of maximizing shareholder value, we can also identify through share price increase or improvement. But we also have a situation when that increase or movement is not a result of skill of the management, but a result of other external factors in the economy which pushed the share price up. Maybe inflation can push a bit, or some other factors. Then management expect some incentives, but they've not done any work. Share options may encourage excessive risk-taking in the pursuit of short-term gains. Remember, I said share options, let me not talk about them now. Okay. Shareholders versus bondholders, another urgent conflict. So remember, as much as the company and as much as the management of the company works for the best interest of the shareholders, they should not at all avoid other stakeholders. Right? So we need to understand the difference between shareholders and stakeholders. Stakeholders now involve a lot, including them shareholders. So we can think of our customers, we can think of our bondholders or creditors, we can think of the government, we can think of suppliers, we can think of employees, a lot, partners, right? So, shareholders, managers should not just be blinded towards the satisfying shareholders. Why? Because you borrowed some money. You need to make sure that the bondholders and the creditors are also paid back. Shareholders versus bondholders, another urgent conflict. Management may shift wealth from bondholders to shareholders by issuing more debt to dilute existing debt value, right? You already have debt. You have already debt in your capital structure, and you issue more debt. That's the reason why, as you proceed, you see that debt holders or banks, when they give loan, they can give debt covenants to say you are not allowed to take more debt than what you have without our approval. increasing dividends, reducing security for debt holders. So you see a situation can happen. Bondholders or creditors have given the company loans, right? But at the end of the day, these companies, they made profit. They are giving the shareholders a lot of dividends, leaving less capital available for reinvestment, or leaving just a little or no retained earnings for reinvestment, risking the potential or the capacity of the company to make future profits and be able to service their debt. So there's a problem with shareholders being blinkered towards, with managers being blinkered towards shareholders at the expense of other stakeholders like bondholders. They're giving a lot of dividends, reducing security for debt holders. Those debt holders, what they can only earn is interest plus their principal that they've already given you. But if you now take all the money that you have generated and redistribute as dividends and leave no money for plowing back as retained earnings for better projects, you are risking your debt serviceability in future. So taking on high risk assets, where gains favor shareholders while losses affect bondholders, those who do risk governance and compliance, RSK 402, you can be even asked this question, right? We will see it when we meet for 02, but I'm not the one who is taking it, but I'm just well versed with everything, right? So you see what happens now. We're saying taking on risk assets or risk investments where gains favor shareholders while losses affect bondholders. You see what happens. You get loans from bondholders or creditors. You invest in high risk investments. High risk investments have the potential of giving high returns. If high returns are obtained, the ones who are going to benefit are the owners or the shareholders. Those are the ones who are going to get high dividends or increase in share price, right? So you are taking more risk. If things go well, right, the bondholders or the creditors will not benefit from such. They will just receive their interest. If you take high risky investments and things go bad, the bondholders will be affected because you fail to pay back the interest. Maybe the company can be dissolved, right? So that's a conflict of interest, because when you take a risk and things go well, you benefit alone, you take the proceeds alone, you just give yourself interest. But in the event that things go bad, we will be affected. So there's a conflict of interest. So that's the reason why I find even creditors and bondholders might have an influence on the operations of the company, so that managers will not take excessive risk which benefit them in the shareholders if things go right, but disadvantage the bondholders or the creditors who lend the money if things go bad. Loan covenants. Debt agreements impose restrictions to prevent shareholder-driven risk. So loan covenants are also imposed by bondholders or creditors sometimes to restrict and prevent shareholder-driven risk, because shareholders can push for more risk so that they can get more returns. So the creditors or the bondholders will impose restrictions to prevent such shareholder-driven risk. Reputation management. Companies maintain good credit ratings to secure future financing. Another thing, apart from those loan covenants, there is also a need to avoid excessive risk taking, right? Because in the event that you fail to pay back the loans and you have challenges with the bank managers, the bondholders, your credit rating will be affected, and you'll be known that you missed the payments, because banks have got communication, and it will be difficult for you to secure another loan in the future. Okay, let's talk key takeaways. Why mechanisms exist to align interests? Urgent conflicts persist. Yes, they persist. Effective governance, transparency. transparent incentives, and balanced risk management are crucial to safeguarding shareholders' wealth. So you see, we're talking about this. Later, soon we'll be talking about more calculations and the like. But do not forget, as much as we're doing those calculations and the like, risk management is also necessary. We need to make sure that as we are doing projects and try to maximize shareholder value, proper governance, effective governance, transparent incentives, and balanced risk management are cornerstones of maximizing shareholder value and ensuring sustainability in the firm growth, sustainable growth. Let's talk about doing the right thing, ethics in business. We're going to be fast now. Ethics in financial decision making. Ethical consideration influence all business decisions and impact corporate reputation. Right? So ethics becomes important